Hello friends, welcome to my channel again. Today we are going to discuss a very important concept which is very much used in the investing world, and it is called as the PEG ratio. What we are going to do in today's video is that first we are going to understand it with the help of a very simple example, and thereafter we are going to apply it to some of the stocks to see how we can efficiently use it. So let's get started on that note. What is PEG ratio? PEG ratio is PE ratio divided by earnings growth rate. So let's understand the P ratio of a company. So the P ratio, as the name implies, it consists of price and the earnings. Earnings of the company is nothing but the total yearly profit of the company. And the price here indicates the multiples which we are willing to pay for those earnings. So let's try to understand it with the help of an example. Let's say I have a small sugarcane juice stand which I am willing to sell. Now the total yearly profit for this stand is 10 rupees. And let's say there is a buyer who is willing to pay 100 rupees for it. So in this case, 100 divided by 10, that means the buyer is willing to pay a 10 PE multiple. Now imagine if the same sugarcane juice stand, there is a buyer who is willing to pay 200 rupees. In that case, the PE multiple will become 200 divided by 10, that means 20. There could be a third scenario wherein I am hardly finding any buyer and the buyer is willing to pay just rupees 50. So 50 divided by 10, the PE multiple will become 5. So in all three cases, we have seen that one time the P multiple is 10, another time the P multiple is 20, and the third time the P multiple is 5. In all three cases, what does it indicate? It indicates that for the same yearly profit, how much money the investor is willing to pay in order to buy that business. Let's calculate the PEG ratio in all three cases. So we have seen how the PEG ratio is calculated for all the three cases. Now let's see the impact of the earnings on the PEG ratio. So in all three cases, what we have seen that in the second case, case 2, we started with a PEG ratio of 2, but as the earnings of the company came quite significant, the PEG ratio drops from 2 to 1. So in many cases, even though we are buying a company which is with a high PEG ratio, if the earnings come through, that will still look cheap. Whereas in the other case, if we are buying the company solely on the criteria of a low PEG ratio, it doesn't mean that we are going to make money. So that's an important point to keep in mind. Now, let's begin with an example to really apply it to the stocks and see how we can find out the PEG ratio. Let's have a look at the one of the company called as Tata Consultancy Services. So this is an IT company, and for this IT company, where we are viewing this data, we are basically viewing it on the stock edge. So you can search the stock edge. You click here, and once you click here, you can put TCS here. Once you come on the TCS page, you have the different tabs. You have to go to the fundamental tab, and once you come down, you can see the PEG ratio. Okay, we can do the same for let's say Infosys. So for Infosys, the PEG ratio is 2.13. So if we see 2.56 and if we compare it with 2.13, it looks like Infosys is available at a cheaper PEG ratio. But we need to understand that in investing, whenever we calculate any ratios, etc., there are two concepts: trailing and the forward. Now, the trailing is something which is already in the past, and the forward is wherein we are putting some assumptions and we are expecting certain kind of a growth rate, etc. And based on that, we are making some calculations. So in this particular case, the stock edge, when it does this calculation, it does the calculation based on the trailing data. Okay, you might also see that here the P ratio, the industry P, the book value per share, and all. It is indicating here at the bottom that it's a trailing 12-month data ending in 2025-09. Okay, so with this, it is very clear that the PEG ratio, because PEG ratio, the formula is the PE ratio divided by the earnings. It is a trailing PEG ratio. So the trailing PEG ratio is cheaper in case of Infosys as compared to TCS. Now, how it is calculated? If you wanted to see, so in the case of Infosys, we have. So let me add it here. It's Infi and it's TCS. Okay. So What we are saying is that for case of Infi, it is 21.29, which is the P ratio, and this is the earnings growth. What earnings growth? If you come here in the sub tabs, you have a growth pattern, and here the 5 years earning growth it is taking, which is 9.99. So we have taken that 9.99, and we have just divided these two numbers to calculate the PEG ratio. So Infosys PEG ratio came as 2.13. So if I check, it is 2.13, which is correct. If I try to do the same for TCS, it is 21.68. So 21.68 is my PE ratio, and 8.47 is the 5 years earning growth. So if I go here and all, if I check, it is 8.47. So if I calculate, it is coming as around 2.56. So this is my trailing peg ratio which I have got. Now imagine a situation if I am factoring in that next year my growth rate could be 15% for Infosys and 17% for TCS, then the same trailing peg ratio, because I'm expecting and I'm making an assumption that the future earnings growth would be like that. So now it will become a forward peg ratio. Now forward peg ratio in case of Infosys for the next year will come as 1.41, and for TCS it is coming as 1.27. So you will see when we are factoring in the earnings, and if the earnings growth are higher in TCS, even though on a trailing basis it is looking more expensive from a peg ratio perspective, but suddenly a future or say a forward peg ratio, it is looking cheaper. So this is one of the way by which you can really consider this one of the ratio for the investment purpose. But for that, I would strongly say that you need to really see what is the future earnings growth which you are expecting, because the trailing peg ratio could be a indicator, but it is not a real indicator which is capturing the future earnings growth. So for the future earnings growth, you need to make some projections. You need to estimate that what kind of expected growth can come into a company, and then you need to decide whether you are paying more or you are paying less.
In investing world, the peg ratio which is less than 1 is considered as cheap for any stock, and the peg ratio which is greater than 1 is considered as expensive. So just keep that point in mind. That's all for today's video, friends. If you have learned something new, then do like, share, and subscribe, and stay tuned for the next video. Thanks.